Hello everyone, this is Dr. Sonam Arora, Assistant Professor, LJ Integrated MBA. Welcome you all to the next video session of subject Capital Budgeting. So in our last video session, we discussed about the non-discounted techniques of capital budgeting, that were payback method and average rate of return method. Today we are going to start with the discounted methods of capital budgeting. Today we are going to take the first method, that is net present value method. Now, before we move to the net present value method, first look out what exactly a discounted cash flow is. The investment decision made by taking time value of money in account is your discounted cash flows. For example, if you invest 100 rupees in a bank for a year at 6% rate of interest, here that 6% is your discounting rate. So, it doesn't mean that your interest rate is always your discounting rate. Now look at the another example. A company invests 100 rupees for a year in a particular venture and earn 8%. Here, this 8% rate of return is considered as your discounting rate of cash flow. It means on 100 rupees, when you get that 8 rupees, that is 108. That 8 rupees is your cash flow at discounting rate. Sometimes this discounting cash flow is always referred as a opportunity cost of capital. Now, look at the time value of money concept one again. So, time value is divided into two main values, that is your future value and present value. Money grows over time when it earns interest. So, you are having two options. First option, that you are having 100 rupees. Put that 100 rupees in your pocket and don't use it. So, it will not grow. It will remain as 100. But when you invest that 100 rupees or put that 100 rupees in your bank account and that particular 100 rupees is earning at 6% or 5% interest rate, that extra 5 or 6 rupees is your interest. So when your particular amount is grow with time, that is your future value. So the formula of future value is PV value multiplied by 1 plus R with the time duration, which we represent here with N. Then what is the present value? So if you are having 10,000 rupees today, or you had a 10,000 rupees 5 years back, or you will have 10,000 rupees in future, that all 10,000 is not equal, because you are able to buy so many things in 10,000 rupees in past. You are able to buy certain things in 10,000 rupees, but it is not necessary that 10,000 rupees will give you same amount of product in future, because there is a change in inflation rate and interest. An investment can earn profit in future. Thus, it is necessary to understand the present value of future cash flow. So, if in future you are going to earn 15,000 rupees, what will be the value of 15,000 is today. So, that will give you a clear idea that what exactly you are going to earn in future. So, the formula of present value is future value multiplied by 1 upon 1 plus R with the whole summation of N. Now, look at the example. But before we move to the example, first look out the definition of NPV. Now, net present value predicts future cash flow and then discount them with appropriate industry rate. For example, if you are having 100 rupees today, if you are having 100 rupees today and if I discount it with 10%, the future value will be 110 rupees. Whereas if you are having 100 rupees in future and you want to discount it with 10% in present, after a year, the value will be 909 rupees. If we do it with the calculation of 1000, and 90 rupees if you do with the calculation of 100 rupees. Now, it is a sum of all incremental cash flows discounted from future to current period. Now, look at the two particular words which I highlighted here. One is a incremental. So, your sum is always be a incremental. Only then you can have a positive cash flow. If you are earning 100 rupees this year and next year you are earning 110 rupees, that is the only benefit. If there is no profit, there will be a no net present value. The second thing is that it is discounted always, because the value of money today is always more than the value of money in future. NPV is the difference between the present value of cash inflow from the project and the present value of cash outflows of the project. So NPV is present value of inflow minus present value of outflow. Now look at the formula. The formula is NPV equals to minus C0. So 0 because it is present. It is your initial investment. It means if I am investing 10,000 rupees today, so my today is always with 0. So the cash outflow is C0. It is also called as your initial investment. The initial investment, when I add in the cash flow of the coming year, which is divided by 1 plus R. So R here is my discount rate. So 1 divided by 1 plus 10%, or I can say 1 divided by 1.10. That is my discount rate, and I am doing this activity again and again, the number of years given there. Now let us see in the next slide. And on next slide, it is our decision criteria. So my decision are in 3 different categories. The first one is my positive NPV. If my present value of cash flow is greater than the present value of outflow, the net PV is said to be positive and the investment proposal is considered to be accepted. So if there is positive NPV, you are going to accept that particular project. The second is zero NPV. It means my PV of cash inflow to my PV of cash outflow, they both are at the equal stage. So NPV is naturally equal to be 0. In this condition, if there is no other option, you accept this. But the third one is negative NPV. Your cash flow is not going to generate anything. Your outflow is already more than your inflow. And this is a very simple condition where there is a negative present value and investment proposal is going to be rejected. So there is 3 type of decision: positive NPV, zero NPV and negative NPV. Positive NPV, you are going to accept it. Zero NPV, if there is no other option, only then you are going to accept it. And negative NPV, you are not going to accept your proposal. Now we will go and study this particular thing with the help of an example. Now look at the example. Example is, calculate the NPV of a project Y which require investment of rupees 25,000. So my initial investment is 25,000. C0 is 25,000. And the estimated cash inflow from the project are 9,000, 8,000, 7,000, 6,000 and 5,000. These are the investment in respectively of 5 years. The required rate of return is 10%. So I make an Excel here. I put my inflows in row wise, that is 9,000, 8,000, 7,000, 6,000 and 5,000. If I see the collective investment is of 35,000. But I discount this particular thing with the 10% rate of return which is given in the example. When I discounted 10%, the first year I got the value which is 0.909. So how I get this value? It's simply 1 divided by 1.10 because my discounting rate is 10%. So the value of rupee 1, if discounted at 10%, after a year become 0.909. After second year it become 0.82. After third year it become 0.75. Fourth year 0.68 and fifth year it become 0.621. So if you are earning 1 rupees, after 5 years the value of that 1 rupee is going to be 0.62. Now I multiply my discounting rate with the actual cash inflow. So when 9,000 is multiplied by 0.909, it becomes 8181. Similarly, I do it with the second year, third year, fourth year and fifth year. And the collective, the total inflow which I get here is 27,000. It is 27,249 rupees. I mentioned it above, mark my words here, that your total cash inflow was 35,000. But when I discounted it with 10% of rate in next 5 years, it is going to be 27,249 rupees. Now when I look at the actual net PV value, it is 27,249. My outflow was 25,000. So 27,249 minus 25,000, it equals to 2249. So after even 5 years, if I discount this whole project with 10%, I'm getting the profit of 2249. So this is your positive NPV. It is your zero NPV if your PV value of inflows are 25,000. So in circumstances, if you are able to get PV value of 25,000 minus outflow again 25,000, so it will be zero. So that is your zero NPV condition. But here it is your positive NPV condition by 2249 rupees. Now, what are the advantages of NPV? So it is a good measure of profitability. Most of the organization and big project use the NPV method. It accepts conventional cash flow pattern and it considered all cash flow over and above the timings. Now, what are the disadvantages? The first disadvantage is that it is difficult in estimation of required rate of return. So in the previous example, it has already given you 10%. But what happens if there is no percentage for your discounting rate? So how you decide the discounting rate of a particular project? So this particular disadvantage is going to be solved in our next session when we talk about internal rate of return. Now the second biggest disadvantage is that it is an optimistic projection. So as I already told you, there is no particular rate, then how you decide it? And sometimes you decide an over optimism that you are going to earn 5% or 10%. Further, the different size of products are very difficult to compare. So you cannot compare a project which is of 25,000 of initial investment with a project which is having 2,50,000 as an initial investment. So it is very difficult to compare the projects which are of different size. Thus, NPV is a very good method which considers time value of money, but the issue is of the rate of return. So if there is no industrial set standard, it is difficult to go to a particular projection rate. For this particular chapter, I use the books mainly are Prasanna Chandra, Khanen Jain, Tulsian and I am Pandey. I prefer you go to these particular books and solve the sum related to the NPV method. Thank you.